coming back to you and OMCs, we are seeing they could be in focus today because we're seeing a sharp decline in the Singapore GRMs. How will this impact the oil refining companies? Could you talk to us about that?
Well, if you see, it's a double whammy for the oil refining and oil marketing companies. Firstly, because the Singapore gross refining margins have declined, and secondly, the Brent crude prices have also surged. Coming on to the Singapore gross refining margin, they have declined to around $3.7 from $5.2 that we had seen yesterday, and from the 2023 peak of around $14.3 per barrel, the Singapore gross refining margins are down nearly 75%. Now, two reasons why this has declined. Firstly, is the spike in crude oil prices, and second is the reason is the fact that the higher refined product inventory has led to this drop in the refining margin. And when it comes to Brent crude, they have surged to around $87 per barrel level, and this surge is owing to the lower than expected inflation in the US and on surprise OPEC voluntary cut in output that we had seen last week. Now, higher crude prices means that the marketing margins of the retail fuel or petrol and diesel comes down for the oil marketing companies. Now, on the refining side, if you see, generally a $1 per barrel drop in the gross refining margin impacts MRPL's revenue by around 700 crore rupees. For IOCL, BPCL and HPCL, their earnings come down by around 14 to 16% by every $1 per barrel drop in GRM, and for Reliance Industries on a consolidated basis, their earnings get impacted by around 4 to 5%. And when it comes to the marketing business, now the current crude prices are around $87 per barrel, and a few weeks back the crude prices were trading around the $75 per barrel mark. So a $12 increase in crude oil prices have reduced the diesel marketing margin by around 2 odd rupees, and for petrol the marketing margins have come down by around 5 rupees per litre for the oil marketing companies.
Well, all right, thank you for that, Soumya.